Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, stocks continuing their relief rally as there's some chatter about the FDIC expanding their deposit insurance. We've obviously still got a bit of selling going on in the likes of First Republic, despite all the deposits that came from the big banks last week. So it looks like there needs more work to be done to stop the deposit flight and restore confidence in the banking system. So that's what officials are working on, seeing if they can get permissions for FDIC to do that. And that's kind of what the market seems to be rallying on. Tech did take a breather. So obviously very strong last week. Tech lagging a bit yesterday, along with Asia, which was also lagging. Gold also pulled back from its intraday highs, knee-jerked up through 2000, but then pulled back. But oil and copper did manage to bounce. Obviously, they got sold last week, having a bit of a stabilization move there. But still a lot of work to do, given how much they've come off. And then Nat Gas couldn't even manage that bounce. So Nat Gas was kind of still down 4% on the day, back pretty much towards its lows now. So the question here is it retesting the lows on lower momentum? And this is actually the time to really get into it because we can get material rally, or are there further lows to come? It seems to be quite weather dependent right now, as Nat Gas often is. So I'm not really doing a whole lot with it myself, just observing. But longer term, some people might think this is a good opportunity to get into Nat Gas. Volatility wise, we did see vols get faded, not massive, but sort of 1 to 1.5 vols across Europe and US, as some calm appeared to come back to markets. Obviously got FOMC looming tomorrow, so any real big vol reset isn't going to happen until that's out the way. VVIX also managing to come down. You see 14 vols off the vol there. And then even commodity vols drifting down about a point across the board, except for miners were bid and Nat Gas was also bid 4 vols as it made lower lows. So looking at carry, European carry negative. It's kind of been that way now for a week or so. But we've got positive carry in Asia and in US. But I wouldn't really kind of hang your hat on any of these carry numbers, just because with a big event like FOMC, a lot can change in a day or two. Remember, this data is backward looking. It's what has just happened versus what is implied. And a big material event like FOMC, where so much has been priced in, and Powell's basically going to have to answer a lot of hard questions, could really materially move markets in either direction. On the carry side, on commodities, we see gold flip back to positive, as realized is kind of stabilizing a little bit despite the big move on Friday. And then you've got positive carry in the energy space still, but we're more neutral in silver and copper. In terms of skew, equity skew drifting back pretty much across the board, but still very inflated percentiles. So still loads of room for that to come lower after FOMC if we don't get a disaster of a move. Precious metals skew also bouncing after getting hammered into deep call territory last week, bouncing back from those lower percentiles that we saw, but an energy skew also drifting off its highs. So remember, we said that ultimate mean reversion trade was to sell calls on gold and puts on oil. That actually would have worked quite well yesterday, but still lots of room to go on that trade. But that's definitely one for the brave, given the dynamics in the market at the moment. All right, what else are we looking at? So looking at these charts, the big question this week is, will Powell hike or not? Okay. And the way I see it, the bond market got caught with its pants down last week. Okay. Speculators were positioned massively short the front end. That's evident from the CFTC data. We saw a very, very big 2-year bond future short here. That's clearly been squeezed spectacularly in the last week. But the question remains, have the fundamentals really changed enough for the Fed to actually pivot? Right. And whilst things do feel quite overdone in the near term in terms of this move in rates, the flight of deposits into money market funds, which is this second chart here, is unprecedented. Okay. And so that you can't deny that move. And until short end rates get cut, or banks offer higher deposit rates to stop the deposits flying out the door, so we're in a fragile situation for the banks, right? So now the chances are they're not going to raise their deposit rates because that will crush their margins, right? So they're just going to start losing money. So really, we're looking for the Fed to stop this flight of deposits, okay? And that's only going to happen if they cut short end rates. Now, given what Powell said in front of Congress 2 or 3 days before Silicon Valley Bank collapsed, it would look pretty stupid if they don't follow through with a hike, at least a 25 basis point one. But as some market commentators are highlighting, that might then mean that they have to cut rates even stronger and faster later down the line if they do put another hike up there. Okay. The truth is, though, because of the lagged effects of rates, maybe that extra 25 bips, if they then go and cut 100 by the end of the year, like the market's pricing, maybe that 25 bips is kind of irrelevant, right? That might be the way they see it, which is why they might just deliver the 25 bips to not look ridiculous in terms of their credibility and what they think's going on. Another thing to be aware of is this upturn in net liquidity from increasing their balance sheet. Obviously, that's something that a lot of market participants are paying attention to now for risk assets in general. But we had a massive crypto breakout on the back of net liquidity turning higher yet again. And we know that crypto tends to be the epicenter of speculative activity. That's something that the Fed has been trying to stamp out and needs to stamp out to get a handle on inflation. So if they were to give the market, let's say, what it wants in terms of a pause and not hiking, then you would think that will fuel a bit of a frenzy in the crypto space, in the speculative stocks like ARC names, and that's just not going to be good for what they're trying to achieve, and potentially undoes a lot of the hard work of last year's rate hikes, right, in terms of bringing down inflation. So another argument why they may want to and need to hike still. Okay. This to me is the toughest balancing act that Powell's ever faced. And I wish him good luck because I wouldn't want his job right now. Okay. Now, what have I been looking at in terms of trades? So the question is, if yields have topped, right, and there's a strong case that, yields have, what does that mean for equities, right? Do equities scream higher on that? And if we look back at 2020, for example, right, that taught us a valuable lesson, certainly taught me a valuable lesson, right? The stock market is not the economy, right? We had a pandemic, we experienced a growth shock like nothing we'd seen in 100 years, and yet stocks were able to bounce back hard because of liquidity conditions and the fact that central banks kept rates on the floor, okay? So the question now is, if bond yields have topped out due to this pivot brought forward or brought early, and even if we go into a recession, does that mean tech stocks still take the market higher? Okay, because tech stocks like that environment of lower rates. We've got our pivot. There's still innovation going on in the tech space. Are we going to go back to that type of market that we saw in 2020? Okay, that's the big question. And S&P back to new all-time highs, about 20% higher than here, is not a scenario that many people are talking about. And we wonder if first, could that scenario happen? And B, are there cheap ways to gain exposure to such a scenario? Okay, so that's when we go to our trusty old dashboards to try and identify some opportunity. And you can see here, been talking about this a little bit. TLT vols elevated relative to S&P. Okay, so S&P vols are about 20, TLT's higher. Doesn't really happen very often. Okay, on top of that, TLT skew has flipped through the zero line, right? So calls in TLT are trading at a premium. Obviously, puts are trading at a premium in equities as they normally do, which means calls are trading at discount. So equity calls look low, bond calls look high. That's basically what we're saying. Okay. So what does that translate into? Well, if we look here, all right, that's the idea for today. And I'll catch you all tomorrow. Thanks for listening.